So this company is a pharmaceutical company that does like treatment for diabetes type 2, but the medication has been shown to help against obesity as well. And because of that, it's become...
Is this the Ozempic one?
I don't know the Ozempic.
What?
I didn't get you. Sorry.
Ali, is this the company that does Ozempic?
Yeah, exactly.
Yeah, I heard about it. Yeah. Everybody's talking about it. All the fat people are talking about it. Because it has weight loss. I know a lot of people who take it with no diabetes. Okay, I'll get to the question part as well. We'll do a question part, and we'll try to do NVIDIA as well. Although we've done NVIDIA, we'll do it briefly. Okay, I'm gonna try to keep an eye on the chat as well as much as possible. So let's go through the stock real quick. So so that's interesting. So I'm guessing the spike. This is the spike since the Ozempic weight loss trend started, right, Ali? That 51%.
Yeah, I think so.
Yeah, I heard about it a year ago on YouTube from multiple diabetes channels. I saw it. One of my good friends runs a diabetes. He's like an endocrinologist, and he runs the diabetes channel out of Florida. So I've seen it. Okay, so let's take a look at the stock. So first of all, look, it's up 51% over the past year. If you take a look at the benchmark, I mean, obviously it's outperforming the market. It's a little bit crowded. Like a stock that does 50% in a year, it's always kind of a crowded trade, and you have to consider if the juice is kind of worth the squeeze. Hold on, let me mute everybody so we don't have any feedback noise. Okay, I muted for convenience. So you have to consider if you want to get into a little bit of a crowded trade. There's a lot of hype around the stock, so usually investing in hype companies, it's not always the best idea, because even if it's a great company, usually it means that it's a little bit overpriced and there's better opportunities ahead. But just kind of an initial thought, it's not always the case, and kind of a general observation. Okay, so it's a $300 billion company, which seems to put it in the big cap, obviously. At 300 billion, it's a behemoth. Yeah, Danish company. Okay, let's look at the numbers real quick here. So sales are going up. For a pharmaceuticals company, that's pretty impressive. I mean, 60% of the past 5 years, 45% of the past 3 years, 25% this year, $177 billion in revenues. SG&A is 50, also up significantly, and pretty much at the same pace as revenue. Operating expenses are also up 26%. So they're spending a lot of money to generate these extra 26% of sales, which is not always a bad thing, but something to pay attention to. So money is being spent here. So operating expenses 73, and that's interesting. Okay, very small considering the fact that the structure of the operating expenses to compared to revenue is actually not that bad. CapEx, that is absolutely insane. Okay, so what they're working with, what, 10% CapEx revenue? That's kind of high, but why is it up? -7.4. It's up 100%. I don't know. I have to take a look at CapEx. They seem capital expenditure kind of heavy, but it's okay. Sometimes with R&D heavy companies, it makes sense, but significant CapEx. Why don't I have net cash? The fuck? Hold on a second. I want to see net cash, net income. Yeah. Sorry. I want to see net income. And I don't know why my profile got changed. Okay. Let's jump back into this. Okay. So operating income is 66 billion, absolutely insane. And net income is 55. Okay. So this is, look, this is where I'm starting to like this, like not specifically as an investment at this price, but I like this idea. Look, if you show me a company that has what almost 30% net income, it's something that's very hard to ignore. I mean, there's not a lot of companies out there who'll give you 30% net income. So 30 cents on the dollar, give or take. Consistently, it seems, because the company over the past 5 years, this is prior to the Ozempic fad, right? So 5 years, 3 years, you can see the company is showing consistent growth. And, you know, diabetes is a good business to be in. Unfortunately, the modern lifestyle isn't amazing. And it's kind of contributing to the fact that, you know, people consume more carbohydrates, they work out less, et cetera, et cetera, et cetera. So diabetes is not going anywhere. So margins are very impressive. And let's take a look at the balance sheet here. So cash and cash equivalents, 12.7 billion. Total debt is 25.8 billion. So this is the first part where I don't like the stock, except the fact that it ran up quite significantly and it's crowded. I'm not a huge fan of companies that are deep in debt. I mean, they have double debt than cash, which is not something I usually like to see in a company I'm excited about. So you also have to understand that, you know, when you're working with $26 billion of debt in this interest rate environment, even though they're Danish, but when the US raises interest rates, the entire world is in an elevated interest rate environment right now and will be for a while. So when you're servicing a $26 billion debt, how much you're spending on interest? Yeah, they're spending almost $500 million on interest. Not too bad compared to the fact that they're generating $177 billion in revenue, but don't like generally to see a lot of debt compared to cash. Assets to liabilities are okay. I mean, it's good. It's not bad. The one thing where I would tell you that this is where it's a no-go for me, Ali, is one thing. The company's terrific. They're in a great business. They have endless supply of customers, unfortunately. Their numbers are insanely good, great margins, great growth. Whatever metric you take a look at here, except maybe the debt to cash ratio, which is a little bit iffy. But in general, it's a terrific company. The problem starts here. When we scroll down here, this is the problem, guys. So this is what I mentioned. I alluded to this in the beginning of the analysis. So this company is trading at a price to earnings ratio of 46. So anybody here knows what the average on the S&P 500 right now on the P ratio? You want to check it out? If anybody can tell me what's the P ratio on the S&P 500 right now, I'd be curious to see it because I think it's a good comparison. We can probably also take a look at other expensive companies like Palantir, for example. So Palantir is not a cheap company, as everybody knows. It's at 8.5 P ratio. If we take a look at Tesla, which is a famously or infamously expensive company, their P ratio is 44. Okay, so it's 44. I'm going back now to Novo Nordisk. So they're trading at a P ratio of higher than Tesla. They're more expensive than Tesla at this point. I don't know what's the P ratio on the S&P 500, but if anybody can find it and tell me, if not, I'll look it up myself in a second. But
it's 22.
Yeah, so it's okay. Thanks, Evan. Appreciate it. So it's trading at double the average right now in the market. More expensive than Tesla, more expensive than Palantir. So it's the problem. It's the same problem with ASML. We looked at this stock a while ago. They own pretty much the lithography business. They make the machines that build the machines that build the chips. And so when you get into a crowded trade like this, when everybody knows about this company, it's terrific. So you're gonna have to pay a premium. I personally, in this market, would not pay 46p on anything except like a Tesla. It has to be something like insane, and it's just too crowded. And the numbers here, like the P ratio, I think where it's at is where you see the problem. So I would say it's a terrific investment, but not at this price.